My name is Mayanka. I am account and a finance trainer from Uplatz. Today in this class we will discuss part 2 of computation of total income and the tax payable. Means part 1 is already covered by us in our previous video in which we have discussed about the steps which are required to be taken for calculation of total income of the assessee. And and in this video we will discuss other steps. Means in part 1 we have discussed that to compute the total income of the assessee, first we will determine the residential status. Of the assessee, of the person. Then we will classify the income in the or under the respective head. We will classify the income under the respective heads. Now we will discuss other steps. Other steps which are required to be taken or which are considered to calculate the amount of taxable income of the assessee. Next step is computation of income under the each head. Now we will compute the income. First, we will determine the residential status of the assessee. Because in the case when there is the person who is a resident of India and ordinary resident of India, all the income will be taxable in India. But in the case of non-resident person, only the income which are received in India, acquired in India, arise in India, will be taxable in India only. All income of non-resident will not be taxable in India. The third step, and in the second step, we will compute the income in the respective head. Under the respective head means salary income will be calculated, or salary income will be calculated in salary head. PGBP income will be PGBP income, means business income will be taxable under the PGBP head. Capital gain, if any, on the sale of any capital assets, then we will classify it under the head of capital gain. So now we will discuss step number 3, computation of income under each head. Now we will, after the classification of income, we will compute the income which will be taxable under the different head, under the each head. So the amount of the income is calculated, the income to be computed accordance with the provision of each head of income. Means according to the particular head of income we will calculate. Means in the case of salary, first we will calculate the amount of which will be taxable under the head of salary. Just like for the example, Mr. Ram, and he earn a salary. He received the amount of salary, for the example 6 lakh rupees. 6 lakh rupees he received amount as a salary. Now such a total amount will not be taxable. Now we will provide less standard deduction. Standard deduction just like 50,000 rupees. The standard deduction is 50,000. So we will provide 50,000 as standard deduction. So the amount will be, so the taxable amount will be 5,50,000. And if there is any other deduction, any other deduction, then we will also provide such deduction. So after the classification, as per the classification, we have classified 6 lakh rupees under the head of salary. Now we will compute what will be the income which will be taxable under the head of salary. Next example, just like there is a assessee and he received rent from house property. Rental income from house property. For the example, the total amount of rent is 4,80,000. Now from such rental income, in the case of rental income, we will calculate NAV, net annual value. We will calculate NAV, and from such NAV we will provide reduction under section 24 subsection 1, subsection A and D. So after such calculation, after such a deduction, the amount will be taxable, the actual amount which will be taxable under the head of house property. It will be taxable under the head of house property. Not a total 4,80,000 will not be taxable. It means the amount which will be arise after providing the deduction. After providing the, just like we will consider that it is the amount of NEV, net annual value. Now we will provide the deduction less deduction under section 24. Number one, 30% is 30% standard deduction. So it will be 4,80,000 into 30%. And interest on borrowed capital. For the example, it is 46,000. So the total deduction will be, so the total amount which will be taxable, this minus this means 2,90,000 will be taxable under the head of house property. It will be taxable under the head of house property. Means after the classification, we will apply the provision of such particular head. We will apply the provision of such particular heads, and after that we will identify. After that we will calculate the amount which will be taxable under the head, under such particular head. After that we will calculate the amount which will be taxable under the particular head, So the income to be computed in the accordance with the provision which are relating to such a particular head, which is relating to such a particular head of income. Assess the income under each head. We will calculate, or we will assess the income which will be taxable under the each head by number one, applying the charging and deeming section. Means to calculate the amount which will be taxable under the head, under the particular head, we will apply, or we will follow the provision of charging section, of charging provision and deeming provision. Means to calculate the amount which will be taxable under the particular head, we will follow, or we will apply the charging provisions and the deeming provisions. And we will also provide deductions to calculate the income. We will provide the reduction, that is the reduction and the exemption. Means excluding item of income which is relating to that head in the respect of which specific deduction are provided in section 10. Means if there is a salary income, and in the salary income if there is a reduction as per section 10, if there is a reduction, then we will exclude it from such amount. Means as per the section 10 there is a reduction of 12,000. Then the taxable income will be under the head of salary. The taxable income will be 5,28,000, 5,38,000. So we will apply the charging section, charging provision and the deeming provision, as well as we will provide reduction and any exemption which are given under section 10, to calculate the amount which will be taxable under the particular head, which should be taxable under the particular head. There are certain income which are wholly exempted from tax. There are certain income which are wholly exempt from tax, just like agriculture income. Agriculture income is an income which will be, or it is totally exempted from tax. Means on the agriculture income there will not be any tax. And these income to be excluded from the gross total income. Means the income which will not be taxable, then it will not become the part of total income. It will not become the part of gross total income of the assessee, because it is not taxable. Also, some income are partially exempted. There are some income which are partially exempted, just like house rent allowance. In the case of house rent allowance, such amount will be partially exempted. Means on the basis of exemption limits. Education allowance is also partially exempted and partially taxable. Partially exempted and partially taxable. So to calculate the actual amount, we will provide these deduction also, or these exemption also. Means which is partially exempted, then partially exclude and partially add. And if it is partially taxable, then partially add, or exempted amount will be excluded. So in this situation, we will compute the tax. We will compute the income under the respective head. After the classification, we will compute the income as per the as per the respective head. Means what will be the income, what will be the actual income after providing deduction exemption, which will be taxable under such particular head, which will be taxable in this particular head, and align the permissible deduction. Permissible deduction we will provide. Just like for the example, we are calculating the house property income. Just like we are calculating the house property income, and from the house property income, we will provide a reduction of interest on borrowing capital or municipal tax deduction. We will also provide the municipal tax deduction, and we will also provide the deduction under section 47 A and B. So after providing these deductions, the value which will be arise, it will be taxable. After providing these deductions, the income or the amount which will be arise, which it will be taxable under the head of house property. Disallowing the non-permissible deduction, the deduction which are not available, which are not permissible, we will disallow it. Then we will calculate the income which will be taxable under the head of particular head. Just like for the example, we have calculated the amount of income which will be taxable under the head of PGBP. Under the head of PGBP, if these expenditure are means in as per the provision of PGBP head, the expenditure, if these expenditure are related to the business, then it will be eligible for a reduction. But if there is a personal expenditure, then the reduction in the respect of such a personal expenditure is not available. Means the reduction in the respect of personal expenditure is not available. It is not allowable. So if there is any assessee, he has taken a reduction in the respect of such personal expenses, then it will be disallowed. Means such expenses will be added back. Such expenses will be added back. Means the amount of income, the amount of profit or gain will be increased. It will be increased. So it will be added back under the particular head. So the deductions which are means the expenses which are required to be disallowed, we will disallow when we will compute the income which will be taxable under the particular head. So when we will compute it, net consideration from capital gain. When in the case of capital gain, when we will compute the net amount of capital gain, net amount of consideration, then the brokerage is permissible deduction from the gross. Means from the gross amount of sale consideration when there is a sale of any capital assets, and the amount of capital gain we will calculate we will calculate. So from the such a sale consideration, we will deduct or we will reduce the amount of brokerage. And on the basis of which we will finalize the amount, means net amount of considerations. But STD paid is not permissible. Means the brokerage is permissible, but STD is not permissible. Means STD is not eligible for a reduction. So when we will calculate the amount which will be taxable under any head, then we will apply the provision of such particular head. We will apply the deeming provision of such particular head. We will apply the charging provision of such particular head. And on the basis of which we will calculate the taxable income which will be taxable under such particular head. Next step is clubbing of income of the spouse and minor child. After calculating the income of the particular head, now we will club the income of the spouse or the minor child. Means if there is any minor child, he is earning or she is earning any income, then his income will be taxable in the hands of his parent. Or if there is any assessee, he has to transfer any asset to his spouse without transferring the asset, then the income from such assets will be taxable in the hands of such person, not in the hands of his spouse. Means just like for the example, Mr. Mohan, he received the amount of rent from house property. The amount of rent is 1,20,000. Now, Mr. Mohan transfers such amount to his wife. Means according to him, now it will be taxable in the hands of his wife. So 1,20,000, it will be considered the income of Mr. Bai without transferring house property. Without transferring the house property. Without transferring the house property. So in this situation, such 1,20,000 will be clubbed. It will be taxable in the hands of Mohan only. If there is a transfer of assets also, if there is the transfer of such house property also, then such income will be taxable in the hands of his wife. But there is no transfer of house property, there is no transfer of house property, then such income will be taxable. It will be taxable in the hands of Mohan only. It will be taxable in the hands of Mohan only. It will not be taxable in the hands of his wife. So this is to be known as provision of clubbing provision. And if there is any minor child, there is a child, means there is a Rahul and he is the son of Ram. He is the son of Ram and he earn or he receives some income. He receives some income. For the example, it is 18,000 rupees. After providing a reduction of 15,000 as per the provision of income tax, in the case of minor child, the deduction is 1,500 is available. So the taxable income will be 16,500 and it will be taxable in the hands of its parent. It will be taxable in the hands of its parent. So now we will discuss such as step number 4. An individual is a higher tax bracket may have a tendency to divert his income when there is any person. For the example, Mr. Mohan, his total income is more than 10 lakh rupees and he is covered just like his income is 10 lakh 8,000. His total income is 10 lakh 8,000 rupees. Due to such excess amount, means up to 10 lakh, that tax rate will be up to 10 lakh rupees, the tax rate will be 20%. Tax rate will be 20%, means 0 to 2.5, 0 to 2.5 lakh, it is 0. 2.5 to 5 lakh, it is 20%, and sorry, 2.5 lakh to 5 lakh, it is 5%. 5 lakh to 10 lakh, it is 20%, and more than 10 lakh, the tax rate will be 30%. It is fall under the bracket of 30%. He's fall under the bracket of 30%. Now, to save the tax, he transferred 1,20,000 the income to his wife. Now his income is 8,80,000. And he fall under the bracket of 20%. He fall under the bracket of 20%. 20% bracket he fall. So in this situation, he will divert to save the tax. To save the tax, he will divert his income. He will divert his income to another person so that he is required to make the payment of tax at less. So the individual who has a higher income, they want to divert his income to the another person so that they will make the payment of tax at the lower rate. At the lower rate, for example, there is an individual may make a fixed deposit in the name of his minor son. There is a SECI and he make a fixed deposit in the name of his minor son so that the income from such fixed deposit will be taxable in his accrue in the name of his son, not in his own name. It will be, according to him, it will be taxable or it will be accrued to his son and it does not become the part of his income. But as per the provision of clubbing, such income will be taxable in the hands of such individual. It will be taxable in the hands of such individual. So, in order to means to prevent this type of tax evasion, that the provision of the clubbing introduced, means the provision of the clubbing introduced by the income tax. So according to this, if there is any assessee transfer any income in the name of any other person, if there is any assessee which will transfer any income to another person without transferring the assets, or he transfer any income without transferring the assets, then such income will be taxable in the hands of such person only. Means if he divert the income, means if such assessee divert the income in the hands of any other person, then we will calculate the taxable income of such assessee. Then such amount diverted income will be added. Then the such diverted income will be added in the total income of such assessee. In the total income of such assessee. Means if such a, for the example, the diverted income just like that, in this situation, such 1,20,000 will be added in the income of Mohan only. It will be added in the income of total income of Mohan only. It will not be added. It will not be considered the income of his wife. It will not be considered the income of his wife. It will be considered the income of Mr. Mohan only. So under which income arising to certain person has to be included in the income of person who has diverted his income in the name of any other person. Where will compute the taxable income of such assessee. Further, income of the minor child, if there is any income which is earned by the minor child, then it will be taxable. It will be included in the total income of the parent. The parent whose total income is higher. Whose total income is higher before including minor income. Means Mr. Rahul, he is the son of Mr. Ram, and he earned 18,000 rupees as income. And the income of Ram, gross total income before adding such income, before adding such 18,000, the total income, gross total income of Ram is, for the example, 5,70,000, and his wife, and the income of his wife, for the example, it is 3,50,000 only. So such 18,000 after provided reduction is 16,500 will be added in the income of Ram. It will be added in the income of Ram. Means the assessee, means the parent whose income is higher, whose income is higher than the income of minor child will be added in his income. Means in the income of such assessee. Means if the income of the wife, the gross total income of his wife is, for the example, 8,50,000, then such 16,500 will be added in his income, not in his income. It will be added in the income of her wife, of her mother, means the minor side. So then such income will be earned, will be added in the total income of his mother, his mother. So further, the income of the minor child other than the income which is derived from the exercise of his technical skill. If it means if the income such 18,000 rupees is earned by the Mr. Rahul from his technical skill, or from his talent, from his mutual work, then such income will be taxable in the hands of Rahul. It will not be club, then it will not be club. But if the income is earned by the such minor child from any other, means other than his technical skill or other than his talent, then it will be taxable, then it will be clubbed in the hands of its parent, whose gross total income is more. So such a interest income will be included in the income of parent. Income in parent as a income from other sources. Means if Mr. Ram, he make the deposit in the name of his son, and he earned the interest on it 15,000 rupees, then such a interest will be taxable in the hands of Ram under the head income from other sources. It will be taxable under the head of income from other sources. After provided a reduction of 1,500, means after provided a reduction of 1,500 rupees. So now we will discuss next step, set off and carry forward and set off of losses. Set off or carry forward or and set off losses means if there is any assessee, he has the income, means the total income of the assessee, for the example, the total income is, for the example, 2,50,000, and there is a For total income is this, and there it is 1,25,000, and there is a house property loss. For the example, it is 2 lakh. The house property loss is minus 2 lakh. Then there is the amount of loss. There is the amount of loss. Means in this situation, in this case, the loss is more than the income. Loss is more than the income. For the example, the assessee has only two income, just like salary. Salary income, it is 1,25,000 rupees. 1,25,000 rupees. And house property income is only 2 lakh rupees. Only 2 lakh rupees. So in this situation, he can adjust maximum to maximum 1,25,000 rupees. 1,25,000 rupees can be adjusted by him in the respect of such a loss. Means there is a loss of 75,000, which is not adjusted. Loss not adjusted. Which is not adjusted. The loss which is not adjusted. So in this situation, so in this case, if there is any amount of loss which is not a set off, then it can be carried forward for the future period, and we can set off such amount of loss in the near future. In the near future, when there will be the amount of profit. So the next step is set off or carry forward to next year and set off the losses. So when there is any SIC, he has the different source of income. Means that there is in any SIC and he is earning the income from the different source of income. Then he may have profit from one source and loss in the another source. Means he is the salary income as well as he has the house property loss. So in this situation, he can set off the amount of loss with the amount of profit. He can set off it. The loss can be set off against the profit. Against the profit means there is in SIC he has let out property as well as self-occupied property. In the case of self-occupied property, there is the amount of loss, and in the case of let out property, there is the amount of profit. So the amount of loss can be adjusted with the amount of profit. It can be adjusted with the amount of profit, and after the set off, we will calculate the net amount which will be taxable under the head of house property after the setup. So if there is any losses in the particular head of income, then there is a requirement to adjust to set off such losses. Inter-source setup of losses. Inter-source means within the source means the person may have income from one source and he may have the loss from another source under the same head. Means there is any assessee, he has the profit, he has the income, from rented house property. For the example, the income is 3,75,000 and he has loss from self-occupied house property. For the example, 1,75,000. This is the amount of loss. 1,75,000. So in this situation, the income which will be taxable under the head of house property will be it will be means we will reduce such loss. Means it will be 2 lakh rupees only. Means the amount which will be taxable under the head of a house property, it will be 2 lakh rupees. Means it is to be known as inter-source setup. It will be known as inter-source, means inter-head. It will be known as inter-source setup of losses. Inter-head change. Setup. The loss of one business can be sort of from another business. Means if there is an SSE, he has two business, and in a one business there is a loss, and in the another business there is a profit. Then the loss from one business can be set off from the profit of another business. Set off of losses from one source against income from another source within the same head. is permissible, and it will be known as inter source setup. But there are some exceptions. Means the long term capital loss cannot be set up with the short term capital gain, but the short term capital loss can be adjusted. It can be set up against the long term capital loss. Means long term capital gain means if there is a long term capital gain, for the example is it 2 lakh rupees, and there is the short term capital loss, of rupees 85,000. Loss is 85,000 rupees. Then the taxable income will be 1,15,000 only. But if there is any short term capital gain, 2,50,000, and long term capital loss, it is approximate 55,000. Then such amount means the taxable income will be 2,50,000. Means the long term capital loss cannot be adjusted. The long term capital loss cannot be adjusted with the short term capital gain. The long term capital loss cannot be adjusted with the short term capital gain. Interhead means we can adjust or we can set off the loss. Interhead means one head to another head. Means if there is any head which has the amount of profit, and the another head has the amount of loss, then we can adjust it, but subject to certain exception, just like the business loss cannot be set off against the salary income. Means the salary income cannot be used to set off the business loss. So if there is any loss in house property, if there is any loss under the head of house property, then we can set off it against any head of income, but maximum 2 lakh rupees, we can set off house property loss. So this is to be known as interhead set off of losses. Interhead means set off the losses from one head to another head, another head. Means the loss of the business can be set off against the house property income or another income, but the business loss cannot be adjusted with the salary income. It cannot be adjusted with the salary income. Carry forward and set off of losses. If in any of the year the total amount of the income is not eligible to set off the losses, then we can carry forward these losses. To the next years, and in the next year we can set off these losses. So unabsorbed losses of the current year can be carried forward to the next year. Unabsorbed amount of loss which is related to the current year can be carried forward to the next year. Next year, and in the next year we can set off these amount of loss with the respective head or with the income. Here again, if there are any restriction relating to the inter-source setup, if there is any restriction, then we will apply. Just like that, the long term capital loss cannot be carried forward or cannot be set off against the means the long term capital loss cannot be set off against the short term capital gain. So if there are these type of restrictions, then we will also follow it. The maximum number of years of up to which we can set off or we can carry forward these losses will be provided under the set, normally 6 years. So for the example, the business 6 year, 8 years means depend upon the head or depend upon the provision. So for the example, the business loss can be carried forward for the maximum 8 years. The business loss can be carried forward maximum for the 8 years, and it can be adjusted from the business income. So the loss from a specific business can be set off only from the income from a specific business. Means the loss of a specific business which is specified in under section 35 AD can be set off. It can be adjusted only with the income of specific business. Means if there is any assessee, he has the loss in the business, and the business is covered in 35 AD, and the loss is For the example, loss is 2,50,000. Then such a loss can be adjusted only with the income of section 3580. It cannot be adjusted with a normal profit. It will be adjusted with the specific business income only. Next step is computation of gross total income. Computation of gross total income. After calculating the income headwise, now we will calculate gross total income. GTA. Now we will calculate GTA. GTA, gross total income. So the step 6 is a calculation of gross total income. Calculation of gross total income. The income which is computed under the each head after giving effect to the clubbing provision and provision for setup and carry forward and set of losses has to be aggregated to arrive at the gross total income. Means after calculating the income which will be taxable under the head of respective head, we will apply the clubbing provision and the provision of set off and carry forward. And after applying all these provision, we will aggregate all these income. We will aggregate all the income, and on the basis of this, we will identify or we will calculate gross total income. We will calculate gross total income. So the process of computing gross total income is depreciated here. Add income which is computed under the each head, means under the each head the income will be taxable. Then we will apply clubbing provision. Then we will apply the provision of clubbing, and then we will apply the provision of set off and carry forward of losses. Set off and carry forward of losses. And on the basis of this, we will calculate GTA, gross total income. We can calculate GTA. So on the basis of this, we have completed part 2 of calculation or computation of total income and tax payable. There are some other parts in which we have discussed other steps. Means we have discussed till 6 steps. Now there are some other steps. By this we will calculate the amount which will be taxable and how, and we will also calculate the amount of tax on such taxable income. So kindly consider all the videos of such topics so that you can understand or you can take the knowledge about how to compute, how to calculate the taxable income and tax which is required to be paid on such income. So thank you so much for watching this video. Okay, bye bye and have a nice day.